thank Bhairav and his colleagues. There's still work to be done with the regulators, but nevertheless, there have been a very large number of changes instituted to ensure that the legislation is ready for the marketplace. But believe me, in Australia, in Canada, in Singapore, the job of improving the legislation never ends. Malaysia most recently. Our next speaker is Jim Sullivan, who's the president of Green Street Advisors. When we thought of what would be valuable to kick off this session in order to understand the growth of the world's biggest market, the US and the Europe, there was only one person that we could think of, and that was Jim, because Green Street Advisors are the most trusted of all of the parties that are right at the center of the marketplace, at the crossroads of the marketplace in the US and Europe. He's been around for a long time. I'm not saying he was around when Eisenhower introduced the REIT legislation as part of the Cigar Excise Amendment Bill in 1960. But he's lived through the evolution of the North American and European market, so he's best placed to say what lessons can be learnt and how can we leapfrog into a version of the market which is state-of-the-art and the one which will serve India's interests and the market's interests. So could you please give him a very, very warm welcome to give his presentation and then a Q&A. Thank you.
Good morning, everyone. Thank you for the kind introduction, Peter, and thank you to APREA for inviting Green Street to be part of this very, very interesting event. I'm going to go through a slide deck. There's a lot of information here. You may be scratching a lot of notes. You may be taking pictures of some of the slides. I will let you know that if you're interested in the deck, approach me or my colleague Justin Brown. Justin, will you stand up? Justin's in the back. So please approach one of the two of us, and we'd be happy to get your business card and send you a copy of the deck if you see something that's of interest to you. So what I'm going to do is go through the history of the US. There are some important lessons to be learned and taken away. I think we'll go a bit through the history of Europe and some important lessons there as well as it pertains to the REIT market. And to give you some context on my perspective on REITs, so Green Street's based in Newport Beach, California. We have 30 analysts in the US that cover about 80 publicly listed REITs. And in our London office, we have 12 analysts that cover roughly 45 listed companies in the UK and across continental Europe. Our clients are the owners of these companies. Our clients are the shareholders. They're the institutional portfolio managers who decide which stocks to buy and sell, which continents in which they want to be investing in REITs, and within different countries, which companies they want to own and which companies they don't want to own. So we're very familiar with global REIT portfolio managers, what they like, what they don't like, and I think all of that perspective is really relevant as we try to launch REITs in India. It's a very exciting time for your marketplace, and I hope there are some key takeaways for you from my presentation today. Why don't we turn the clock back a little bit, and what I show on this slide, and I hope you can see it. If you can, I'll walk you through it. But in the US, as Peter referenced, REITs were created in 1960. And why were they created? They were created because our legislature thought that, hey, it would be a good thing for investors to be able to not only buy stocks for their portfolios, not only buy bonds for their portfolio, but to buy commercial real estate as well. But for many retail investors and smaller institutions, there was no access to commercial real estate. I don't have enough money to go buy an office building. I don't have enough capital to buy a beautiful hotel like the one that we're in today. So REITs were created by legislation that said, we want to create a liquid, transparent vehicle for investors to invest in commercial real estate. And here's the deal. If those REITs distribute out almost all of the income that they make to their shareholders, we're not going to charge that entity any corporate income tax. So that was the bargain. Create a REIT, publicly list it, provide access to commercial real estate. If you distribute out most of your profits, you don't have to pay any corporate income tax. That was a pretty good bargain. So REITs were created in 1960, but in the US it was a very small industry for a long period of time. And the seminal event happened in 1991. So for anyone with gray hair, and there's not too many in the room beside me, in 1991, the real estate market in the US was in a depression. Asset values had fallen from 1989 to 1991 by about 50% on average. Commercial real estate values fell 50%. If you had lent money to real estate people, you probably couldn't get your money back. If you had been an equity partner with someone in real estate, you probably lost most or all of your money. So in 1991, real estate guys were bad guys in the eyes of the capital markets. So along came a company called Kimco. And Kimco was a very well-run company, the owner of shopping centers. And Kimco had an idea that, hey, maybe I can convert my private real estate company into a publicly listed REIT. And Kimco was told, you're crazy, but if you want to go try to figure that out, talk to these guys at a company in Newport Beach, California called Green Street Advisors. So Kimco came to Green Street and they said, we want to go public. What do you think? And it was a very difficult time for anybody to think about coming public. But what Green Street told Kimco was, if you have a chance at all, you're going to have to do some things. You're going to have to be completely transparent about your portfolio. You're going to have to create enormous alignments of interest between the management team of the REIT and the shareholders who you're asking to become your partners. Maintain a focused strategy. It's really hard to be great at one thing. Owning shopping centers, it's really hard to be great at 3, 4, or 5 different things, like shopping centers and hotels and office. It's hard to do all those things at the same time. So stick with retail, and maybe that story will resonate. Kimco came public in 1991, and it was a eureka moment for the real estate business in the United States, because between 1991, when Kimco came public, in 1995, we had 90 REIT IPOs in the United States, and they almost all followed the Kimco model. Transparency, alignment of interests, focus, low leverage. 90 IPOs. I'm not saying that in India we're going to see 90 IPOs. I hope that we do. But for REITs in the United States, the Kimco deal was the start of what we call the modern REIT era. What this slide depicts is the equity market cap of the US market versus that of Europe. So the lighter green is the equity market cap of the United States, roughly $1 trillion today. The darker green is Europe, so it's the equity market cap of the REIT industry in Europe. And you can see some points in time here, 1995, the same size, 2010, roughly the same size. And today, the U.S. REIT is 3 times the size of Europe. Why'd that happen? Well, there are a couple of reasons I would cite, and one has to do with the flexibility of the structure. So, what can you do, what can you put into a REIT? Does it have to be an office building, a hotel, a warehouse portfolio, or can it be something like data centers? Can it be healthcare real estate? Can it be cell towers, cellular towers? Leverage. The REITs in the United States tend to use less balance sheet debt than the REITs in Europe. Insider ownership. So as an owner of a REIT, I get a lot of comfort if the people running the REIT every day own a lot of stock in the REIT. Very common to see high insider ownership in the US, very uncommon in Europe. Internal management versus external management. We'll talk a lot about what that means in a moment because it's a really important topic for your market. And then lastly, non-core sectors. The US REIT market has defined real estate in a very broad way. It's not just office buildings and shopping centers and hotels. It can include cell towers and data centers and things that are a little bit new and different when it comes to commercial real estate. This is the most important slide in the deck, so bear with me while I tell you a little bit about it. So in a lot of markets, I think investors in REITs and real estate companies are looking for yield. What's the yield? What's my dividend yield? is how much is the dividend going to go up? How much is my yield going to us at Green Street, REIT investment is a total return business. The dividend yield is important, but the total return, the dividend yield plus the share price appreciation that I get is even more important. So what this chart depicts is these dark green bars. This is a group of 50 REITs. This is a 10-year time period. The dark green bars reflect the cash flow growth at the properties that these REITs own. So this is how the cash flow has grown at the properties that the REITs own. And there's not a lot of differentiation. The REITs in the United States range from pretty good at running their real estate to fantastic. So there's not much differentiation in how the property cash flow performed. The light green bars are where the action is. So the light green bars represent annualized total returns generated by these REITs, ranging from 25% a year to minus 10% a year. Extraordinary differences in total returns. So you're naturally going to ask the question, if the property performance was pretty similar, how on earth did a company that owns warehouses, right here, versus another company that owns warehouses that produced better property cash flow growth, how did the total return for this warehouse owner beat the other warehouse owner by 10 percentage points a year for 10 years? It has very little to do with the property and has everything to do with the things that management teams have control over. So let's talk about that. So what does the management team have control over that drives total return? Well, the most important thing, exclamation point, is capital allocation. So real estate is a capital-intensive business. It requires a lot of capital. The capital that is collected, whether that's in the form of debt, whether that's in the form of equity, what the management team does with that money on behalf of the shareholders who own the company is the key differentiator on the previous slide between the companies on the left that delivered fantastic total returns and the companies on the right that disappointed again and again. So the biggest advantage of being a public real estate company is access to capital. You have the widest menu of options as to where you get your money. You can get debt, mortgage debt, you can get corporate bonds, they can be secured, they can be unsecured, that's the debt side. And then on the equity side, you can issue common stock, you can issue preferred stock, you can issue convertible preferred securities. Public companies have access to capital in a much broader array than any private real estate company. It's the key reason to be a public company. When you're a public company and you have to deal with shareholders and you have to deal with pesky analysts like me asking you hard questions about your company and its strategy, that's not the fun part about being public. The fun part is this giant menu of places where you can go to raise money. But then what do you do with it? And what do you do with it? You buy things. You perhaps develop properties. You perhaps buy other companies and participate in mergers and acquisitions. And then sometimes what you do with the capital when things aren't going so well is maybe you buy back your own shares. Share repurchases are a big deal these days with a lot of REITs trading at discounts to their net asset value. So if someone asked me on the previous slide, what's the differentiation between the great companies on the left and the not so great companies on the right? It's how did they raise capital and what did they do with the money and when did they do it? That's the most important responsibility for a management team of a REIT. Low leverage. So in the private market in a lot of different countries around the world, 50% debt is sort of getting started, 60's better, 70's great. And in the US in 2007, it was not uncommon to see real estate participants using 90, 92, 95% debt. Well, when asset values drop 30 and 40%, if you start with 90% leverage, guess what? You just lost your equity investment for you or whoever gave you the money. The key point is that REIT investors like low leverage. The good news in your REIT legislation is that there's a legislated cap on the amount of debt that a REIT can have. I think that's a good thing. It's consistent with what global REIT portfolio managers want. They want less debt and more equity, and I think India is in a good spot. I'll note this is the U.S. average, 31%. That's debt divided by the market value of the assets. 31% in the U.S., 41% in Europe. And when I pointed to the growth of the U.S. market and the lack of growth in Europe, this is one of several factors why I think that's happened. Development. Real estate people love to talk about development because it's really exciting. It's fun to build things. It's fun to work with architects. It's fun to look at renderings. It's fun to take pictures of shiny new buildings. That's fun, right? And so real estate people love development. But the reality is development is risky. Development can be very risky. And the lessons we've learned in the US is that public companies who are allowed to do a little bit of development tend to make the biggest bets at exactly the wrong time. So when the market's just starting to get good, we make small bets, and then we make money on development. So the market's a little bit further along in the cycle, we make bigger bets. And when the market's getting into the tail end, that's when we make our biggest bets. That's fourth quarter 2007. And this is the green bar is volume of development for the US REITs. Pace of development peaked right before we had this thing called the Great Financial Crisis. So these projects were delivered in 2009, 2010, 2011. Guess how they turned out? Not very well. So the key point here is that development can be a fantastic business. In the hands of the right developers, huge amounts of value can be created. But development has a very, very different risk profile than owning income-producing properties. Some of the beautiful office buildings that you see right around this neighborhood, this hotel complex, for example. REITs are designed to own high-quality real estate that generates a consistent and growing cash flow stream that will deliver a total return to investors, a chunk of which is dividend, and a chunk of which is share price appreciation. Too many people don't make the distinction between the rewards, but importantly the risks of development, and the very different investment you make when you own a cash-flowing portfolio of high-quality commercial real estate. And I'm happy to talk about that in some more detail. I mentioned external management. So if you're not familiar with these two terms, internal management versus external management, I'll just explain that briefly. So an external REIT is one where there are no employees at the REIT. The REIT instead signs a management contract with an outside advisor who runs the REIT day to day. The employees of the manager, the term you use, the employees of the manager, they make the capital allocation decisions. They manage the balance sheet. They decide when to acquire. They decide when to develop. They decide all of these incredibly important things that affect my interest in that company as a shareholder. That's the external management contract, or the external manager concept. The internal manager concept, which is almost universal in the US REIT market, it's widely accepted in the Australian and the European markets. The internal manager is simply a scenario where the REIT has its own employees. It has a chief executive officer, it's got a CFO, it's got a chief investment officer, chief legal counsel. The employees are working for the REIT, not for an external advisor. This internal versus external model is a source of great discussion. Which one's better? What are the pros and cons of each? The reality is in the India market, it's been legislated that the REITs have to be externally advised. So given that, as an investor in these companies, I want the decision makers who control capital allocation, balance sheet management, do we buy, do we sell, do we develop, I want them to be aligned with me as a shareholder in the company. I want them to get rewarded for making the REIT more valuable. I don't want them to get rewarded for being busy or doing things or being active. Create value for me as a shareholder, and I'm happy to reward you as the manager of my company. And so these external advisory or external management contracts and how they're structured and how the fees are set and how the motivations are established is critically important. So as you bring REITs to the market, there will be a lot of examination of these external management contracts. What are the fees? How are they structured? How is the management team motivated to make the value of what I own, the REIT share, go up? It's a really big topic, and another thing I'd be happy to talk more about after the presentation. Corporate governance. So think of the REIT portfolio manager sitting in London who doesn't really know India, doesn't really know the supply and demand drivers for commercial real estate. If you bring REITs listed in India, he may have a 2% portfolio allocation to India. He's going to spend about 2% of his time thinking about India, thinking about his investments here, thinking about the company he owns a piece of. 2% is not a lot of time. So that portfolio manager in London or Amsterdam or New York City or Sydney wants to be assured that there's somebody watching out for their interest because they can't be there every day as an owner of the company. And that's where the board comes in. So that's why the board composition is really important. As an investor, I want independent board members. I want people whose only interest is looking out for me, the shareholder. And when you have sponsors, when you have related party transactions, that gets a little bit opaque. So corporate governance is the big topic. The point is, as a shareholder in the company, the portfolio manager sitting in London, I want to know that someone's watching out for me, forcing the management team to make good decisions that are good for me as an owner of the company, and that's what corporate governance is all about. So when you invest in real estate, you got to pay somebody to run your real estate. And whether that's a fund, whether that's a manager, if you're going to invest in commercial real estate, you got to pay somebody to run it for you. And that's where we get into this concept of I guess your term being the manager's fee or the trustee's fees. The point here is that the more efficient the operation is from a cost standpoint, the more I'll pay for it as a REIT portfolio manager. For example, if you have two different companies, they own identical assets, they have the same balance sheet, but one of them charges me a point a year and the other charges me a half a point, 100 basis points versus 50 basis points, I'm going to pay more for the company that only charges me 50 basis points a year versus one that charges me 100 basis points a year. Efficiency, how that affects valuation, that's the key point here. And then why don't we finish with considerations for India? What this depicts is the globe and which countries have REIT regimes. And these are scaled by how big the markets are. So the blue scale, of course, the United States. So our market cap is over $1 trillion, our equity market cap of the REIT industry over $1 trillion. The green are successful REIT markets, but where the market cap is a bit smaller. Orange are places where REITs exist. There's not that many, or the equity market cap's not that big. And the black depicts markets where REIT regimes have been established, but we're still waiting for there to be some momentum and to get more companies listed. The key point is that the REITs are expanding across the globe because they're a good thing. They're a good thing for the real estate market. They're a good thing for certain countries in terms of the pace of real estate development. There's a lot of reasons why REITs are really good, and APREA, I think, does a terrific job helping governments and other entities understand what those advantages are. But this is a snapshot of where REITs are and where they're headed. I talked about flexibility in the U.S. versus Europe. We have this structure called a taxable REIT subsidiary in the U.S. And it's a long name, and the acronym TRS is a little bit confusing. What it really means is that as REITs have become more active, they found that, hey, the legislation says we're supposed to collect rent from real estate, and then we're supposed to pay out most of that rent to our shareholders in the form of a distribution. But as we're running our portfolio, we keep running into all these businesses that we'd like to provide to our tenants that would make them happier and might generate some profit for us. So things like utilities, things like third-party property management, running buildings that the REIT doesn't own, but someone else wants to hire me to run it. REITs are supposed to collect rent and pay out distributions, but there are all sorts of related businesses to owning a commercial real estate portfolio that can create value for the REIT and for the REIT shareholders. So this taxable REIT subsidiary is kind of a catch-all for all of those businesses. The taxing authorities in the US have said, we'll let you do those businesses. It's not rent collection like we wanted you to do, but as long as it doesn't get too big, we'll let you do some of that. And it's created enormous flexibility for REITs in the US that you don't see in most parts around the world. And so as India becomes familiar with REITs, as the REIT legislation gets tweaked to allow different things, this taxable REIT subsidiary and some of the businesses run within it are something that I'm sure you'll hear more about. Maybe the most important of which is for sale construction. So build a building, most REITs will build a building, they'll hold on to it, they'll lease it, and they'll own it for a very long period of time. But sometimes the right decision is to build a building and then sell it at a profit right away. Very hard to do in a REIT structure. That's what this taxable REIT subsidiary allows at least a little bit of. Apartments, multifamily. So the concept of institutional ownership of multifamily or apartment complexes in the US is so commonplace. As an American, it astounds me when I go to the UK, or I go to Australia, or I go to China, or I come to India, and come to learn that there is no such thing as an apartment market. And what are we even talking about? So we build lots of apartments in India, and then the units are sold individually, sometimes to residents, sometimes to investors who then lease out those units. In the United States, we have buildings, 200, 300, 400, 500 units that are all owned by one owner who rents all of those units out to people who want to rent those units. This is starting to change. The UK is trying to create an institutional apartment market. There are a lot of folks in Australia that are trying to do the same thing. And when I look at India and I look at the housing situation, it wouldn't surprise me at all that over the next 5 to 10 years, there's a lot of discussion about how we create an institutional apartment market in India, as opposed to this, let's build a building, let's sell the individual units, and then move on to the next development. So concept that I encourage you to be familiar with. I think you'll hear a lot about this in India over the next couple of years. And I think the UK and Australia will provide a very interesting path as to how it might be done and what some of the considerations might be. This is just a summary of some of the key things. As the question comes up, hey, will that portfolio manager in London or Amsterdam or New York care about India if we list some REITs here? And these are some of the statistics that I think will really capture their attention. So when I look at the top row, population, the US, 325 million people, Europe, 500 million people, India, 1.3 billion people. The scale is hard to comprehend as an American looking at your market. GDP growth, 2.26 trillion in India. That's a big number by a lot of context. There's a lot of economic activity here, but it's the third line that really captures the attention of somebody like me, and that's GDP growth. So we look at GDP growth in the 2 to 3 range in the US and in Europe, and then we come to India and we see numbers that start with a 6, sometimes a 7. Extraordinary GDP growth, which for any financial person, any capital markets person is really exciting. But then the bottom row, how many REITs do we have in these different locations? 225 in the US, 88 in Europe, and to date 0 in India. That to me speaks to an extraordinary opportunity for your market. And I'll wrap up with why do REITs make sense for India. And I think, my view is it's extremely compelling. The time is right. The structure is ready. And I think that REITs in India make sense for a number of different reasons. So the first is to support the rapid growth of the economy. When you're growing your GDP at 6 or 7% a year, that's a lot of office jobs. That's a lot of middle class development. That's a lot of retail demand. That's a lot of warehouse need. There's a lot of stuff that needs to get built. And REITs are a way to support the real estate industry in a way that, to the second point here, it lowers the cost of capital. So if you can attract capital to your market from around the world, that's good for REITs, That's good for the sponsors of the REITs, but it's good for the entire real estate industry, because that capital flowing from around the world will make the cost of capital cheaper for the entire real estate industry in India. Another reason why REITs make sense in India, to provide additional capital for real estate developers. So we talked about development, we talked about risk. Developers are really good at developing, and they need a place to find capital, and building buildings, selling those buildings to a REIT, taking that capital and going out and developing more is a wonderful cycle. And so REITs absolutely provide additional capital to real estate developers, maybe not directly, but certainly indirectly. And then when you get down to that, again, that portfolio manager in London, and does he want to invest in REITs in India? You can't do that today. You can't find a liquid, transparent, well-governed way to own commercial real estate assets in India right now. And REITs will provide that alternative. And I think that will be very compelling to a lot of portfolio managers from around the world. And then finally, we talk about infrastructure. And I know that there'll be some discussion about entities that are directly in the infrastructure business. But think about REITs as a way of promoting infrastructure development. When you think about, say, a business park, maybe similar to this one, you think about all the infrastructure that services this, some of which I assume was paid for by the government, some of it I assume was paid for by the developers of these buildings. But infrastructure is another place, and infrastructure development is another place where REITs can play a really positive role. So I've learned a lot about India over the last couple of months. I'm excited about REITs in India. It feels to me that the time is right. I think there are a number of compelling reasons why REIT portfolio managers from around the world will be really interested in India. And I think the responsibility for the first REITs that do get listed is, number one, own high quality assets. Number two, have terrific sponsors. Number three, really understand the points that I made earlier on capital allocation, balance sheet management, disclosure, transparency, alignment of interest, corporate governance. Get that right, and I don't think we'll have 90 IPOs in India, but we'll have a lot more than one or two. And I think that's the opportunity ahead. So I wish a lot of success to the people in the room who are either helping REITs get listed, who are REITs, or are private real estate companies that want to become REITs. And I'd be happy to chat with anybody, and my colleague Justin Brown in the back after this presentation or later today, and tell you more about what we think. Thank you.
So we're going to have questions. Maybe Jim would like to
Okay.
take a seat. So, thank you. We're going to have questions from the audience. I mean, there was a fantastic perspective there. The entire history of North American and European REITs rolled into about 25 minutes with all of the lessons. So please get your questions ready, and I'm just going to ask one to begin with. The US needed a crisis to kickstart the modern REIT era. So did Australia, so did Japan, Singapore, Hong Kong. It was the Asian crisis. How is India going to be different? Or do we have to wait for the first crisis and everybody will get their act together?
A crisis tends to make things happen faster because decisions have to be made quickly. But I don't think it's a prerequisite to REITs being successful in India. And the reason I think that is the capital markets for real estate are now truly global. So capital, whether it's equity or debt, flows around the world looking for the best risk-adjusted opportunity it can find. And I don't think that was the case 10 years ago. I know it wasn't the case 25 years ago in the US. So capital flows freely around the world looking for the best risk-adjusted opportunities. And I think when that capital looks at listed REITs in India, the things that will be compelling will be the pace of GDP growth, the amount of demand versus the existing supply of high-quality real estate. And some of the names that have been bounced around as the potential sponsors of some of the first REITs in India are terrific names, very high-quality sponsors that I think will get the benefit of the doubt from global portfolio managers around the world. So crises make things happen faster, but I don't think it needs to be the case in India by any means.
Definitely, thank you. Okay, who'd like to ask Jim a question? Sir, if you could just... Do we have a microphone? Yeah, here's one.
Good morning. Thank you very much. It was very interesting perspective of the US REIT. My question is specific to that slide which you showed the cash flow from the property and the total return. Because of the capital allocation, how the REITs perform very well. The biggest conundrum in India is the pricing of REITs. So when you advised Kimco in 1991, what was the pricing? How was it advised? How did you find out? And what was it compared to the other returns of other assets given by the shareholders there or received by the shareholders there?
Yeah, so how should REITs be priced is the broad question, and thank you.
But more important, when you don't have any comparables in the nascent market, how does it price? Pricing?
So it's pretty easy to price REITs when you have 10 different REITs that own office buildings in New York City. You can compare one to the other, you can look at the quality of their assets, and relative pricing is easier to accomplish than a market where you don't have 10 REITs to compare to. I would put it to you this way, as an investor, when I buy a REIT, what am I buying? So what I'm buying is a corporate entity that owns high quality commercial real estate. So as an investor, I should be willing to pay the value of the assets. I should be willing to pay the net asset value. I should be willing to pay the market price for what the REIT owns as a starting point. And then, if this is a management team that has consistently proven their ability to create value above and beyond the value of the assets that they own, they've bought in a very smart way. They've chosen to develop at exactly the right time. They've been really disciplined when it came to capital allocation and balance sheet management. If it's a management team that consistently, when I give them $1, turns that into $1.20, I'll pay a premium to the real estate that they own for that company. And then finally, a public REIT provides liquidity. And liquidity is not very valuable when real estate capital is abundant and cheap. But in 2008, 2009, liquidity was worth an awful lot. So as a REIT investor, what's the value of the real estate? What sort of premium will I pay for a talented management team that consistently creates value? And what am I willing to pay for liquidity that I get in a REIT versus the illiquidity in a lot of other real estate investment types, such as buying an office building, no liquidity. Buying an office REIT, if I don't like my investment, I can sell it this afternoon on the stock market. So I would argue that a starting point to think about what's the value of a REIT is the NAV plus something for liquidity plus something for a talented management team that could create value. And you see that. In the US, REITs historically have traded at about a 5% NAV premium on average. And I think that's an interesting way to start answering the question, even in a market where you don't have a lot of comparable companies to compare this REIT against that one versus that one.
Next question. We've got two here. We'll take the...
Hi. So my question is, what's your view on the currency fluctuation and its impact on the return expectation from a foreign investor?
It's a great question. So there's been a lot of headlines about currency fluctuations, emerging market currency versus the USD. There are a lot of variables to that. So the first question is, what does the devaluation do to interest rates? As many of you know, interest rates and cap rates tend to be correlated. When interest rates go up, cap rates tend to go up. When interest rates go down, cap rates tend to go down. And so the first order is what's the effect of currency fluctuations on interest rates and on cap rates and then ultimately on real estate. The other residual question is what happens in a devaluating sort of economy or currency, what happens to the broader economy? And as we think about who are the, say, office tenants in a lot of the beautiful office parks in this city and other places, these office buildings, these are multinational companies that have chosen to be in India for a lot of reasons, one of which is access to talented and educated people in the workforce. And for a company sitting in the United States thinking, should we hire more people in India or should we hire more people in the United States? Guess what? Hiring people in India just became that much more attractive option. So interest rates and what happens to interest rates when currencies change, that's point number one. But point number two is what's the impact on the overall economy? What's the impact on demand for real estate? And when the currency declines in value versus the USD, your initial reaction might be that's a bad thing. But there's positive arguments too, especially in terms of what it means for adding people, adding skilled labor, investing more in India because it's cheaper when you see that sort of scenario on the foreign currency exchange.
Thank you.
So what about the volatility, what Peter mentioned earlier, in the Asian markets has got high volatility compared to the US and Europe markets. So, and also the assets in real estate in India is having more leverage, so compared to US and UK. So how is that going to affect the REIT valuation?
So if I'm a portfolio manager, I'm sitting in London or Amsterdam or New York, what I want is diversification. I want the most diversification I can get around the globe. And I want that diversification to come in the form of great real estate companies who own really high quality real estate. And the volatility, if I were to buy only one company in one market, then I need to really consider volatility, an emerging market versus an established market. But for portfolio managers who invest in REITs, that volatility is actually a good thing when it comes to diversification because I want to be invested as broadly as I can. I want the companies to be with high quality sponsors, high quality real estate, and by having 100 or 200 or 300 different options around the globe, I can smooth out that volatility in my own portfolio in a way that creates a lot of diversification. So certainly volatility will affect cap rates. It will affect total return expectations in an emerging market versus the US. It's the reason why cap rates are 8 or 9% in India and they're 3.5 to 5 in the US. That's the reflection of that volatility. More return in return for taking on more risk or more volatility.
Okay, thank you.
Yeah, thank you for this opportunity. So just wanted you mention that the cap rates in India is close to around 8-9% versus the other developed markets, which is pretty less. So just from a domestic investor perspective, given for an investor who where the interest rates are lower and the cap rates are higher, how is it possible in India's perspective where even the government yield is close to around 7.88% and you get a cap rate of 8%? So considering the risk factor which are involved in the asset class. Thank you.
Yeah, I think it's attractive to look at cap rates versus interest rates. And if I can get 7% from a bond investment, shouldn't I get more investing in real estate? I think that comparison is incomplete. I think the other thing you need to think about is what sort of growth am I going to get in my cash flow? And I would suggest in this market that if I could invest as a portfolio manager, if I could invest in a portfolio that had very high growth prospects, I might accept a yield today, a dividend yield today that's lower than say your 10-year yield, because over time that cash flow growth will give me a return not of 6% say today, 7% tomorrow, 8 2 years from now, and something higher after that. So I think it's understandable why this comparison between say a dividend yield and an interest rate is made, but I think it excludes the extraordinary cash flow growth that I think is available in this market because of the economic growth, because of the imbalance of demand for real estate versus supply. And I think that's an important consideration that I encourage a lot of the people in the room and anyone who's looking at REITs in India to think about, because I could see a scenario where I'd accept a very low yield today because the cash flow growth prospects for the real estate portfolio are so compelling. So I think that's a challenge for anybody sponsoring a REIT to educate the marketplace But I think there are two components. It's what's my yield today, but more importantly, what's the growth in my distribution over time based on how well the real estate is going to do in terms of generating increased cash flow.
And a final question, sir.
Thanks a lot, Jim. It was a good oversight of the US market. My question is, you made some points about internal and external management in particular, and we still see that in US and the Europe, it's predominantly internally managed. So how have you seen that change over a period of time since the 60s to now? And how do you expect that to be as India gets started in that REIT regime?
You know, what it really comes down to is alignment of interest. So in the US, we used to have a lot of externally advised REITs, and today we don't have many. And that's because investors required that the managers making these really important decisions about capital allocation, balance sheet management, I don't want them to be working on a variety of different things. I don't want them to spend a little bit of their time on my office company and then a little bit of time on a retail company for somebody else and then a little bit of time developing condominiums for someone else. I want them to work full-time for me. I want them to own the same shares that I own, and I want them to go to work every day and go home every night thinking, what can I do tomorrow and what can I do today to make the share price go up? That's why the internal structure is so widely adopted. And the external structure provides a similar opportunity if the contract is structured with the right incentives for the management team. But I would note that we had external structures in the US. Today we largely don't. We had a lot more externally advised companies in Europe. Today that's a much smaller number. And Australia is an interesting case study where nearly 100% of the companies 20 years ago were external, and today the vast majority are internal. This market will have to learn REITs, it'll have to learn about these contracts, it will have to put things in place in these contracts that are very shareholder friendly. And I think if that's done correctly, the external structure will raise questions for that portfolio manager in New York or London. But I think the answers, if done right, can be pretty compelling.
A brilliant way to finish on that positive note. So, Jim, thank you very much for firstly introducing the whole, Stephen Hawking did a short history of time. You've done a short history of REITs in both North America and Europe. You've also hit on some key themes that I think today we're going to keep coming back to. One will be internal versus external. The other is going to be, what sort of spread is going to be required between the sovereign bond rate, the risk-free rate, and what REITs are offering, and how is that different between international and local investors, and a range of other matters. You did it brilliantly. Ladies and gentlemen, please thank Jim Sullivan.